Okay, so today this is understanding the principles of individual taxation, state returns, and how they affect federal returns. My name is Derek North. I'm a Premier Account Executive and Continuing Education Director and an enrolled agent here at Federal Direct Tax Services, and we're going to be going over the following things. First off, different filing requirements for different states, how they intersect with federal taxes. You're going to be going through a couple of different reporting and professional requirements for certain states, and primarily talking about tax reciprocity and differences in universality, how it intersects with the federal return. What this is not, and I may possibly be able to handle some of those types of things at the end, but what this is not is a how-to or a walkthrough of filing a specific state, because obviously every state could probably be its own webinar, and I'm not going to go through 50 different things in 1 hour. That's just a lot of content. That being said, starting off, which states do tax? Well, which states do tax? With the exception of 9 states, all of the states have an individual income tax. That includes Washington, D.C. And I'm going to say includes Washington, D.C. for a reason. I know it's not a state, but generally speaking, when I'm talking about states, this is what I'm referencing. Of those 9 states that don't have an individual income tax, 2 of them have a limited income tax of sorts on interest and dividend income. That's Tennessee and New Hampshire. The remaining 7 states do not have any form of state-level personal income tax. That's Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. Typically, states that do not have a state income tax make it up in other ways: higher property taxes, more sales taxes, franchise taxes, excise tax, things like that. Tons of different other types of taxes. But since you primarily are focusing on filing an individual tax return, that's what we're going to be talking about is individual income taxes, and those 7 right there are a no-go. Talking about state taxes and state tax rates, every state is different, obviously. There's wildly different income tax rates and different formulas. Some states have really low taxes. Some states have really high. Some have really high corporate taxes and low individual, and some states are the reverse. It really just depends. Generally speaking, however, state income tax rates are lower than their federal counterparts. For whatever your income bracket is, most states taxing in a progressive system, generally speaking, you're going to have whatever your federal marginal tax rate is, your state rate is going to be lower than that. States also tax individuals differently based upon whether they were considered residents, part-year residents, or non-residents. And the residency status itself can be a very simple thing to determine in some cases, or it can be very difficult. Most of the time, though, it's not going to be too much of a problem. There are 4 states that can require a taxpayer to prove it, and that's California, New Mexico, South Carolina, and Virginia. It's not something that you prove on a return. Usually you can specify the dates that you move in and out on a return for like part-year returns and so on, but those 4 states right there actually do have a little bit more robust legal protections for what they consider, domiciled or resident or non-resident, and in a worst-case scenario, they can actually request proof that the taxpayer is not considered a resident. They're usually a little bit stricter with their tax regimes on that in order to keep their funding good, especially California. California is probably the most difficult one out of that entire little subsection. Residency status is very important. This, for instance, in the software that Federal Direct Partners have access to, is what's going to determine whether or not you have a certain type of return, like whether it's part year, full, or non-resident. In the desktop software that we use in-house, for instance, where the state abbreviations are placed into to load up the forms, has 3 separate columns, if you will: a full year, part year, and non-resident, and it loads up the appropriate form. Generally speaking, with your resident taxpayers, those resident taxpayers are those ones that are considered to have lived the full tax year in the state. And what they consider to be a full year resident does differ based upon the state that you're in. Some states require that the full year resident means that they have to live the whole year, 100% of the days, to be considered full year. Some states, it's, if you live in the state for over 6 months and things like that. It's different for every state. Part-year resident taxpayers are considered to have lived some part of the tax year in the state. Usually that's when they either move in or move out of the state for the first time. Then the tax calculation for those is typically based on either calculation of their state sources of income or a formula of proration, where they will take whatever you earned in the state and then make a basically make a percentage based upon the total income that that taxpayer has for the year. And a non-resident taxpayer considered to have not lived within the state, they're not considered a resident, and likewise they're pretty much the same way. They calculate either a state sources of income or do a proration formula over state source versus total income and then multiply everything. Speaking of that residency too, by the way, a really important point to note is that military taxpayers are usually pretty much just allowed to choose wherever they're considered residents, even if they live in a completely different state. They live in a physically different state across the country. Most of the time, they're still able to keep their residency status, whatever they had before, whatever they wanted. Their home of record, if you will. Their spouses have the same treatment because of the Military Spouses Residency Relief Act, or the MSRRA, which was signed into law in 2009. And like the long and short of it, there's obviously differences for every state, but basically speaking, if the taxpayer is on official duties and their spouse is or is not, the spouse can stay home or come with the taxpayer, doesn't really matter. If they're on official duty, official orders, despite being physically present in this other place, it doesn't necessarily change their tax home or their state of legal residence. You know, taxpayers who have their legal home in Texas, for instance, and maybe they're in the Navy and they're stationed in Virginia, you know, they're not filing a Virginia return in many cases. Each state is different on how income derived from military taxpayers is treated, and that's really important. I know, for instance, in the software that we use in-house, there's actually a checkbox at the bottom of the W-2 input form where you can specify whether the taxpayer is considered full year active military or whether they're considered National Guard of some kind or reserves, because there are different state laws that exclude all or part of the income from military taxpayers in certain circumstances. So military taxpayers got a couple different rules. You'll want to check in many cases, and I'll show you guys how to, or talk about how to actually access different, you know, help features and where to look for stuff like this. But most states have a pretty identical system, and there are like little minor differences. The taxable income base, which is what's going to be used by the state to determine what is taxable in the sense of the state return. When you're talking about residence, there are 4 different ways that states calculate it. The first one and the most common is based off the federal AGI. So they take the state, they start with the federal AGI, and then they modify it. They add and subtract stuff to it. It's on a state-specific level, and those types of returns may also allow for a standard or itemized deduction and personal exemptions, and some of them instead have a tax credit, like a non-refundable tax credit, for instance, instead of a personal exemption. And if you are new to taxes, this may be your first webinar, or you haven't seen any of the earlier ones where we're going over terminology, for instance, I'd recommend checking it out. And otherwise, what I'm talking about is there's a difference between taking money away that is taxed or having something substitute for tax withholding. A credit is money that goes against your tax balance, and exemption is taking away income that is considered taxable. And most states, the vast majority of them, start with the federal AGI and then modify it. The next one is federal taxable income, which is, instead of starting with the federal AGI and then doing state-specific modifications to it, they start with federal taxable income, which is the back page of the 1040, or the second half of the 1040 EZ, for instance, where it already has factored in personal exemptions, standard and or itemized deductions. It starts off already reduced and then has state-specific modifications. Those states do not have personal exemptions, and they do not have itemized or standard deductions because that's already factored in to the base that they start off of. There's also state-defined income, in which case the federal return is not even factored into it. They don't even go off of a federal starting point. They calculate all their income, included or excluded, based on their state law, which is technically how the other ones function in like a strict reading of the text. But basically these ones are almost like the federal AGI one, only they just don't reference it in their legal starting point. They're going to probably end up having most of the same amounts by the time they're said and done. They'll have a few state-specific additions and subtractions, but it'll probably closely mirror the federal AGI. And like the federal AGI base, they may also have standard or itemized deductions and a deduction or a credit for personal exemptions depending upon that particular state. And the fourth one is the one that only applies to Tennessee and New Hampshire, which is where the total interest and dividend income after their personal exemptions is subject to tax. And I got a little map here that's actually describing what I'm talking about. So the ones that are in red on this, and if you have your handout, you can definitely see it. The ones that are in red have no personal income tax whatsoever. The ones that are green are the ones that have their own state-based calculation and don't make reference to the federal return. Even if the end result's very close, they don't use the federal return. There's no federal return connected to it. And those ones, for instance, we've got Arkansas, Mississippi, Alabama, Pennsylvania, New Jersey, and Massachusetts. Our yellow ones, New Hampshire and Tennessee, those ones right there are based off of interest and dividends only. The purple is the one that starts off with federal taxable income, as in it already takes into account the federal exemptions and deductions. That's Vermont, South Carolina, Minnesota, North Dakota, and Colorado, and everywhere else starts off with your federal AGI, which if you're looking at a 1040, a Form 1040, you are talking about line 38 on the back side of this, or on the top of the back side or the second page. Okay, I'm going to go ahead and continue on. Part year residence. When it comes to part year residence, there's two different ways that they calculate it. The first one is AGI received as a resident. In that return, it's kind of like the state-based, as in it only identifies outside of the federal return, separate from the federal return, identifies the state-specific or state-sourced income that's coming to that taxpayer. The items of AGI that are received only while they're a resident, and then all of the deductions and items of exemption, when they are available, are prorated by a ratio of income received to total income. So if I lived in the state, it doesn't matter how long I lived there. Let's say I lived there half the year, but I made a third of my money in that state. It's going to go off of the ratio of total income, not the ratio of time or anything else like that. The prorate calculated to full year basically does a full year return and then divides it up and prorates it based upon the time that you're in the state usually. And sometimes that can also be based on income, but like these are the two main ones that are there. And I got a little map here to show you exactly what I'm talking about. This one's a little bit simpler than the other one. On a red, there is no state income tax, so we disregard it. Obviously, Tennessee and New Hampshire are in here to show how the part year residence is calculated, but keep in mind those two are only interest and dividends. Everywhere else that's colored is either prorated based on the full year or blue, which is based upon the AGI received as a resident of that particular state. Taxable income base for non-residents have one of two different ways of income, just like the part year resident, and it pretty much follows. They're technically termed differently, but it's pretty much the same thing. You have your state-based source, AGI. They take the total amount of state-sourced items of AGI, prorate everything based upon the ratio of state AGI to the total income that they have, and that calculation usually also extends to deductions. So they're non-resident if they have access to a deduction or an exemption of some kind, then they take whatever that formula is, multiply it, and then reduce their taxable income by that amount and determine their tax base. And there's also the prorated full year calculation. It's the same treatment as the former, where they take the full year resident return subject to a proration formula. It's also worthy to note that usually non-residents have a lower tax rate as well on both the state and on the local level. And we'll get to local taxes in a little bit because those definitely do factor in. I also want to point out that this is really important too. Non-resident returns typically do not get state-specific tax credits. There are a very large number of tax credits. Some states have a couple, some states have a lot, some states have even really big ones like the various forms of state-level earned income credit. New York being a perfect example, like very large values. I've seen it add thousands of dollars to a refund before. Typically, your non-residents are not going to get access to it. And in many cases, part year residents also do not get it or have to have everything prorated based upon their, whatever calculation they're using to determine that taxable income base. To give you another map again, non-residents, this time it does include Tennessee and New Hampshire. Non-residents don't get taxed on their interest and dividend income whatsoever. Everything else, obviously, that's in red doesn't have an income tax whatsoever. And then the other two are, the other two colors, your green is your full year proration formula, and the blue one is only the state-sourced AGI. It's almost like the other map. There's a few differences. Oregon gets flipped treatment, for instance. You can see right there. It swaps between the two. Most of the time, though, it keeps the same character for both non and part year residents for both of them. Pensions, annuities, and IRAs. For anybody that's new in the for anybody that is new in the audience, for instance, pensions, annuities, and IRAs, this is your retirement, your individual retirement accounts, your fixed income supplies. That's what we're talking about here. There are also varying degrees on different types of exemptions from and inclusions for various types of income. Some states tax everything, some of them tax none of it, and some of them tax each type differently. Generally speaking, though, most states are not going to tax Social Security and railroad retirement income. And the ones that do tax Social Security and railroad retirement income typically only tax the portion that's considered taxable on the federal return. If your income gets too high, Social Security and the Social Security equivalent portion of railroad retirement income becomes taxable, and those are capped. They're not going to ever take the full amount. Most states, by the way, also have partial exemptions for pensions from governmental sources. And like I said, this varies widely between states. To give an example, in Illinois taxes none of it. Social Security, railroad, federal pensions, state, local government pensions, military pensions, private retirement, nothing. None of it gets taxed. Something like California, on the other hand, California taxes everything except Social Security and railroad retirement in their full value. And like I said, it varies differently between each different state, but that one right there, pensions, annuities, oftentimes, at least I know in the software that we have, if you load a 1099-R, which is the reporting form for your pension and annuity income, there's actually checkboxes on the left-hand side to tell the software what type of retirement is it. And in the state-specific instructions in the software we use, for instance, it actually gives you a small section in each one that says, okay, if you have railroad retirement, check this box. If you have governmental pensions under these accounts, check this box, and so on and so on. Corporate taxes. Corporate taxes is not something we typically do. I am bringing it up, though, because it is only a little blurb. Of the states that are there, 44 states have some form of corporate or business level taxes. The rates range from as low as 4% in North Carolina all the way up to 12% in Iowa. 6 states have no form of corporate tax at all. That's Nevada, Ohio, Texas, South Dakota, Washington, and Wyoming. Washington, D.C. also lacks business taxes. Now, I would like to make a little point out for Texas too. There, it's a different calculation for Texas. I do want to point out that there is some franchise tax which may or may not fit into the corporate tax, but there's no business level return like you're going to have like an 1120S or something. Texas is a unique case. I'm not going to spend too much time on the corporate taxes, but I just want to point that out. I also want to point out too is that 2 of the states that I listed above, South Dakota and Wyoming, have no individual income and no business taxes whatsoever, and everything is essentially replaced with property and or sales use taxes. Local taxes are probably one of the biggest headaches for tax preparers who are filing returns with the states, because the local taxes in many cases often have very specific rules for how they're input into the software, and they are treated differently on a state-by-state basis, because basically in addition to your top-level state tax authorities, there are a lot of them that have local tax authorities, which can be anything from counties to cities to school districts to economic cooperatives of multiple cities, counties, and states and districts. It can become wildly complex. So I give a list here, for example, of the states that have some form of sub-level taxes: Alabama, California, Colorado, Delaware, Indiana, Iowa, Kansas, Kentucky, Maryland, Michigan, Missouri, New Jersey, New York, Ohio, Oregon, Pennsylvania, and West Virginia. In commercial tax software, there's very often a very specific way. To give an example, in the software that we use here, when you're doing the county level description, you might be looking at a W-2 and see, for instance, Indianapolis, where we're based out of, is called Marion County. I might look at a W-2 and it says Marion. If I go type Marion into the software that we use, the software won't even record that there's any local taxes paid. So in many cases, the software has a specific way that it gets reported. And I know, for instance, that for Indiana, it's a letter C for county followed by a numerical designation, C49, for instance, for Marion County, because it's the 49th alphabetical listing in our county listing. And that's how it gets reported. And every state has their own different formula, as in sometimes certain letter-word combinations, a restriction on the number of spaces. So become familiar with your software and play around with it, especially in advance, to try to get a handle on the upcoming season about any sort of restrictions that you may face and ways to take those W-2s that come into your office and make sure that they're input into the software good, because you don't want to miss out on those local taxes, because not only does it affect the amount of tax and that they're either going to pay or get a refund for on their state return, it can also affect their federal return, which is really the last part of what we're going to be talking about. Some of these local taxes that I'm mentioning too, for the states, are assessed only on the employer. For instance, California doesn't have local taxes except for San Francisco, and those are only assessed by the employer, on the employer, for the wages that they're paying for their employees. Same thing happens in New Jersey with employers who are based out of the city of Newark. New York does something as well, similar, where they have the Metropolitan Transit Authority taxes and taxes for the people on the waterfront. In addition, and that's in addition to any other local taxes that they have, like the New York City or Yonkers taxes that apply to the individual. And as well, there's Oregon and West Virginia have certain local jurisdictions, local tax jurisdictions, that also have levies for employers in the state. Generally speaking, though, all the other ones, the local taxes are imposed directly on the individual. They go directly against the individual. And how they do that is really depends upon where you're living. I know it's going to be a lot of exceptions to the rule, and unfortunately in state returns, you got to become familiar with the ones that you are, the ones that you're actually preparing. Typically, your local taxes are based on the county and or city. Sometimes there's school districts. Ohio is a good example. In many cases, they can overlap one another, and I bring up Ohio, and Ohio is a special case because it has multiple overlapping and competing jurisdictions. There's the Central Collection Agency, which is CCA, and the Regional Income Tax Authority, or RITA, jurisdictions. There's school district taxes. There's city-specific taxes, both in an actually named form and in a generic city tax form, and the top-level state tax. And all of those can be on one return. And it can be rather confusing in that case. Some states, when they do their local taxes, the local taxes are based on the same income on the state return. For instance, Alabama, Delaware, Indiana, Iowa, Kentucky, Maryland, Michigan, Missouri, New York, Ohio, and Pennsylvania use the state taxable income as the base for the local taxable income, which is usually represented as a percentage. Some states, on the other hand, only tax certain types of income. Colorado and West Virginia, the West Virginia being one of those ones that applies to the employer, only tax wages and compensation on the local level. And so even though the state itself might tax you know, all the sources of income on the local level, they're only taxing, for instance, what people are earning as an employee. Some of them are based on a percentage of state income tax. So instead of actually taking in and adding up all the income and coming up with a percentage, they just go to the state return, say, oh, you're getting charged $1,000 of state tax. We're going to take 20% of that. Iowa school districts, Yonkers tax. Yonkers is 15% of whatever the state tax value is. Intangibles, Kansas has hundreds of different taxing jurisdictions that tax intangible income only. So basically, if you have interest, dividends, or security transactions, money market funds, things like that, and you're in Kansas, you're going to have a tax assessed, possibly based on where you live, for just that income only. On the local level, the state tax level is still going to be taxing all the income based on your residency status, but the intangibles are going to have an extra additional tax on a local level. And like I said, at this point, if your head's swirling around, yeah, it can get rather confusing on the state level returns. So my suggestion to you is get familiar with what state returns you're going to do, and maybe a couple of the ones around you. Texas, for instance, doesn't have state taxes on a basic personal income tax level. So you think, well, I'll never have to deal with it. You might be right. Maybe, however, somebody comes from Arkansas, maybe somebody lives in Louisiana, maybe somebody lives in Oklahoma, or works in either one of those places. So it's good to apprise yourself. Most of your local taxes are based on a percentage formula, like the usual tax calculations. Some of them, however, are based on a flat fee that follows a time schedule or are a combination of the above. As in, there are actual places, for instance, like Kentucky, for instance, even though I reference it down there at the bottom, some places in Kentucky don't actually do a percentage. They just do an amount of dollars per week that an individual works in that particular county. It's strange. And some of them are just a flat fee in general, X number of dollars per month, based upon where you live. Usually the local taxes are calculated in a subsection of the state return, like part of the state return, and any of the final overpayment / balance due is reflected onto the top level state, and then the top level state will be the one to assign the monies or the amounts owed to the various jurisdictions below them. Sometimes the local taxes become a deduction. Kentucky, for instance, treats all local taxes as a deduction, like a local, an inside the state itemized deduction against their tax liability. And other times, local taxes are reported separately from the state and have no bearing whatsoever on the top level state return. Ohio, Pennsylvania. When I was talking about Ohio with the CCA, the RETA, the city, and the school district taxes, those are separate forms, sent separately. They do not affect the regular state return, typically. I mean, except for maybe a reference to the amount of money that they paid overall into their final tax liability, but those returns can be sent separately. And for things like Pennsylvania, in some cases, they actually have to be sent separately, as in you have to go to the city website, download the forms, print them out, and use a pen on an actual desk and mail it in. That's how that works sometimes. Tax reciprocity. Tax reciprocity is an important facet of this. I am going to go into more detail about it, but we're about halfway through the hour, so I'm going to go ahead and kick off this polling question to get everybody in here, get their attendance recorded. Have you ever prepared a state return? Yes, often. Yes, occasionally. Yes, once or twice. No, / first tax season. I'm going to keep this open for about a minute and a half, so if anybody in the audience needs to, feel free to go ahead and get you answered. I figure that since I don't really know the demographics of the entire list because I didn't go through where everybody who was attending, it's a lot of people, where they're from, I'm imagining it's probably going to be mostly in the yes, often category. That being said, it doesn't matter what you pick. If you are watching this in a recorded fashion instead of attending the live webinar, you do not need to frantically click your screen. Instead, you will take an examination with a couple of questions at the conclusion of the course to log your participation. Otherwise, if you're sitting at your house or office or in a McDonald's or in your car or driving down the road listening on the phone and accessing it on your phone or whatever, feel free to click something so that way your attendance is logged. I see most of you have voted. There's still about 15% of the audience out there who hasn't clicked anything yet, and we are running on about 30 seconds left before I close it down. All right, getting there, about 10% of you left. If you have the ability, I'd recommend clicking on the screen. I'm going to keep this up for about another 15 seconds or so, and then we're going to close down the voting. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, and close. I'm going to go ahead and share the results with you guys. As you can see, about almost 2/3 of the audience said yes, often. The rest of them, yes, occasionally, yes, once or twice, and about 15% said no, first tax season. Obviously, people who live in states that don't have a state tax burden or who are newcomers to the industry probably have never filed them, but most states have a state income tax and therefore have had to file at least one. So that's pretty much follows about what I expected. And now we're going to go ahead and hide this, and we're going to go ahead and switch over to tax reciprocity. Now this kind of applies to a question that I saw coming over on the right hand side under the question panel, talking about residents that live in one state and work in another. And what this has to do with what I'm talking about is that many of these states have what are called reciprocal agreements, meaning they don't tax income from each other. So most of your reciprocal taxes are kind of an East Coast / Midwest phenomena. The Great Lakes, for instance, the states around the Great Lakes, most of them have agreements for one another where they won't tax each other's income for people who work across the borders. Most of these reciprocal agreements are two-way, and most of them also have more than one state to which they apply. Kentucky is a great example. Kentucky has reciprocal agreements with so many other states. Some states have a lot of them. Great Lakes, I mentioned before. I've got a list here. If you have the PDF from the handout section, either during the live presentation over there on the handout side or downloadable from the course screen. This gives you an example of a state that you can live in and states that are reciprocal with it. For instance, Illinois means that if you live in Illinois and you work in Iowa, Kentucky, Michigan, or Wisconsin, that there's a reciprocal agreement. Some of the other ones, like I said before, Kentucky, Illinois, Indiana, Michigan, Ohio, Virginia, West Virginia, and Wisconsin. You work in any of those states and live in Kentucky, it's a reciprocal arrangement. They don't have to tax. You don't have to withhold for those states that you're working in. Outside of Washington, D.C., if you live outside of Washington, D.C., you can get a reciprocal arrangement with Washington, D.C. and not have to withhold any Washington, D.C. taxes. I'm not going to spend too much time hovering on this. Feel free to take a look if you want. Most of this stuff, by the way, can be easily handled in advance. Because obviously if you're working in the state, the employer is going to probably withhold state taxes for the state that they're working in. If you are a cross-border worker, you reside in another state that does have a reciprocal arrangement, there are exemption forms that you can use that you can fill out for your employer, and you can get that over, and it basically stops withholding. So that way that taxpayer does not have to file a state return. So, you know, I come back here and I take a look. I live in Indiana. I got an arrangement with any one of these. If I drove across the border to Ohio every day, I could give an exemption form to my boss so he wouldn't withhold Ohio taxes. Now, if you did withhold money from that other state, you can obviously file your non-resident return and get a refund for any of those amounts that you paid into the system, but you can take care of it in advance and possibly avoid that extra work, or your client can help avoid that extra work, extra filing challenge when they file their own returns as it's coming up. It's sort of like the healthcare exemptions. The earlier you can identify that one of these types of situations exists and you can get it handled, the easier it is in the future because it cuts down on the administrative work. And that non-resident return, get that current withholding as a refund. Usually if you are working in a state with a reciprocal arrangement, you can get all that money back most of the time. Most states that do have reciprocal agreements do have a section on the state return in many cases to reflect and report by saying, hey, I have income from this state, check here, and so on. I know Indiana, for instance, actually has a section on the state level return to identify that there is a reciprocal arrangement type of deal in effect. In many cases as well, you can also claim a credit against your resident state tax for taxes that are paid to other jurisdictions, which is probably going to go more on that question that came into me earlier about taxpayers who have multiple states that they got withholdings for. Because of the complexity of state tax laws and the fact that they don't all calculate the same tax base, you know, some of them only count state level AGI, some of them start from the federal, which basically means they include everything and add and subtract to it. Can be a lot of difference between one another, and you may have states that end up taxing the same income. And you can typically account for this by taking a credit for the taxes that are paid to the other states. If you end up having a situation where a person needs to figure out what they paid to another state and get a credit on their top level or their primary state return, it is usually advised for you to finish the non-resident and part year returns for those states outside their legal residence first, because the total tax burden for those states is going to be the basis of that claim. And I want to point out, and I'll say this again in another slide, is that does not necessarily equal the withholding amount. Just because I have $1,000 withheld to this other state doesn't mean that's what I can claim on my personal return, because I might get a refund of some or even all of that money back from the other jurisdiction, and therefore I have no basis for a claim or a lessened one. Each state is different. None of them give this in a refundable fashion. I mean, it might increase the refund if the taxpayer's withholdings are obviously not being allocated to paying a tax burden, but the credit itself is not going to be considered refundable. It is going to be capped to whatever their resident state taxes liability happens to be, and those are based on that final net tax liability for the other jurisdictions and not just based withholdings. I told you I was going to say it again, and here I am. So if a taxpayer was withholding to a non-resident state or a part-year resident state and they get all of it back, there's no basis for the credit. There's no tax calculation that they need to have on their personal return. I do want to point out that that full net tax liability is what that's based off of. So if you do have a part-year residency situation where a taxpayer moved from one state to another and they owe the other state, that full value, even if they didn't necessarily pay it, is going to be the basis for the credit claim on their new state, their new address, because they still owe that money. They're still being charged that final net tax liability. Sometimes it's done on a separate form, as in you do a separate form and that's by itself and that goes to substantiate the claim. Sometimes it's part of the main form itself where it's just like a little line entry where you put in income and taxes paid to the other state or assessed to the other state, and then it factors it into usually a ratio. Most of the time it'll be a percentage, like I earned 20% of my income in this other state, so they're going to take 20% of my other state's tax liability and apply it against my current state's tax liability up to my taxable liability. A lot of the word liability flying around. Long story short, this is something you definitely take advantage of, and you can play them off one another. There's no like feedback loop, so usually you pick one state to be the recipient, but taxpayers who did have multiple states of residence, part-year residency or whatever, if they do qualify for the credit, they can oftentimes try each one to see which one would give them the greater benefit. So at that point, you get as close to done as possible on both of them. Try the credit claim, try it on another one. In the desktop software, there's even a what-if mode for you to play around and see what it would look like. Whichever one gets you the best tax burden or the least hassle to deal with, definitely use it to take advantage of it. Speaking as well of state level restrictions, there's also professional requirements. This does apply to some people in the audience, I know that for a fact. Otherwise, for pretty much most of the rest of the country, it doesn't really apply at all. At a federal level, the only requirement that is required to do taxes whatsoever is that you have a PTIN number. You go on the IRS's website, you take 10 minutes to fill out their application, you pay them $33. Congratulations, you're a tax preparer. However, there are 4 states that do have professional requirements. California is probably one of the most significant ones. The registration is administered by the California Tax Education Council, called CTEC, on behalf of California's Franchise Tax Board, or FTB. New preparers, they have to take 60 hours of CE and obtain a surety bond before they apply to become a California Registered Tax Preparer, or a CRTP. Afterwards, they need to obtain 15 credit hours a year. I meant to say 15 federal and 5 credit hours for California a year, and register by certain dates in order to stay active. Where it matters, by the way, for anybody who is in the audience that is a California preparer and has not registered, the deadline for that is 11 days from now, and as of today, Federal Direct is registered with California. In order to offer those credits. So if it's something that you were waiting on, we were just approved today. We should be able to have the course and everything uploaded and ready to go within a very short time frame. So something to keep in mind. And California is probably the most significant one that I'm going to be talking about in the list, because California represents roughly 1/6 of the population in the entire country. So it's pretty significant. That being said, I'm going to go ahead and get the screen back going here. Got that 5 of which must be from California tacked on there. New York is another one. New York requires all commercial preparers to obtain a New York Tax Preparer Registration Identification Number, or the NYTPRIN, or the TPRIN, in order to prepare returns for New York. They have to obtain 16 credit hours of continuing education for their first year, or have enough experience through their return volume in the prior years, and then take an additional 4 hours each year after that. All of their CE stuff is done entirely inside their state system. I don't remember the name of it. It's like SLIDES or SLAMS or something like that, the acronym for it. It's done either in person through their various councils that they have throughout the year where people can go attend and get credits, or done online. And I want to point out too that this restriction technically applies nationwide, as in New York wants all people who file New York returns, regardless of where you live, to get this number, which requires paying them $100. So anybody who's New York, you're going to have to get that NYTPRIN in order to do it if you're a commercial preparer. And most software platforms will not let you file without having that number or marking one of the numerous exemption codes that exists. So it technically applies nationwide. Whether or not they have the power to enforce that restriction across the whole country is obviously a legal gray area. Maryland is newer. Maryland requires preparers to take and pass an examination over federal and state tax law with a third-party provider, and then they register with the Board of Individual Tax Preparers, and it needs to happen for all preparers in the state. Afterwards, they have to take 16 credit hours every 2-year registration cycle. It's a biennial registration cycle, and pay them $100. 4 of those credit hours have to be in Maryland topics, 2 of which can be substituted by any federal course in ethics. Our content for that, by the way, for Federal Direct is actually already in the process of being approved. We should hopefully have word on that within the next week or 2 once they finish reviewing it. So anybody who's in Maryland, keep that in mind. I will like to say too, for Maryland preparers, as of right now, you will need to pass the examination before you start preparing in Maryland by the end of this year, by December 31st. Oregon is the most difficult, and it's probably the reason why there probably are not any Oregon preparers in the audience. Oregon requires 80 college-level hours and passing an exam just to get the right to start preparing, and then afterwards they have to get 1,100 hours of on-the-job mentoring and experience before they pass another test to be able to offer the full scope of tax preparation and representing taxpayers when they're practicing in Oregon. And as a consequence, Oregon has among the lowest, if not the lowest, rates of tax fraud in the country, and kind of serves as a basis for a lot of other states that are considering their own registration laws. Outside of Oregon, most states don't have a lot of the stuff that I just discussed for people who are enrolled agents, CPAs, or attorneys. Those 3 categories, and in some senses probably also enrolled actuaries and enrolled retirement plan agents, those people are usually considered exempt under the various state-level registration. Most of those state-level registration regimes as well, if you are in Maryland or you're in Oregon or you're in California and you actually are active and enrolled in one of their programs, they make you an exempt preparer for the purpose of the IRS's voluntary annual filing season program, which means that those individuals don't have to take the AFTR course and take that 100-question test to get their annual filing season program record of completion. So if you are considering doing the AFSP program and you're already in California and you're already signed up, or you're in Maryland and you're already signed up with their state level and your requirements are met, make sure you get enough CE and you consent to the Circular 230 disclosure when they send that to your PTIN inbox. Effects on federal returns, and this is really going to be probably the most important part and part that really qualifies this this whole discussion for the credits that we give out for it, is talking about how state level return affects the federal return. Pretty much most of your state returns are not going to affect the federal on their own. They're entirely inclusive, with 3 main exceptions: itemized deductions for your state and local income taxes, or your itemized deductions for your state sales tax, and the federal taxability of state tax refunds in following years. There's also a few tax items that have different tax treatment between the federal and state returns. So 529 plans for contributing to 529 plans for kids, that has no effect on a federal return, but they're usually deductible on the state level. In a lot of places as well, tax-exempt municipal interest and bond income from state and local governments is usually not taxable on the federal level, but is added back to the state level. So some stuff does have that additions and subtractions I mentioned earlier between the 2 of them, but those first 3 are the most significant: your itemized deduction treatment for state and local, your sales tax, or the taxability of the refunds. That being said, deductibility of state tax. This is probably the most significant aspect of it, and that's because state and local income taxes or the state and local sales taxes, one or the other, they're mutually exclusive, can be deducted as an itemizable expense on the Schedule A, assuming they choose to itemize their deductions. The former is the easiest, as in the local income tax rates, because it's basically just the local income tax paid during the year. 99 times out of 100, it's just going to be what they withheld, and that goes on your Schedule A line 5A. The state sales tax is the more difficult of the two and is placed on Schedule A line 5B. Only one of the two can be chosen, and the state sales tax deduction is something that was originally on an extender and had to keep getting updated, and with the passage of the various laws over the last few years, it is a permanent feature of the tax code. For the state and local income taxes, you combine your withholdings for the year. You combine the taxes that you pay during the year for prior year returns, not including any interest or penalties. You pay your estimated payments that you made during the tax year, including the portion of state refunds that are applied to the following year. So if you filed last year and said, well, put all of my state refund into my estimated payment, that also counts. And then there's a few different mandatory contributions that you can also include, like California, New Jersey, or New York non-occupational disability benefits, Rhode Island temporary disability benefits, so on and so on and so on. Generally, mandatory contributions to various workman's comp or unemployment funds or family leave programs are typically also added into it. Mandatory being the key operating word there. So for the state and local income tax deduction, when you do get those amounts together, don't reduce it by any refund that they expect to receive or by the value of any prior year refund that occurs right now. So if I'm doing this and I'm taking that and I just got my 2014 refund for the state because I filed it late or something, you don't reduce it. Your refunds of prior year state and local income taxes are potentially income in the year that are received, and we'll discuss that in a little bit. And for the and basically anything else that you're going to have, any refunds, is going to be covered under the recovery of itemized deductions, which we'll talk about as well. The state and local sales tax, however, is the more difficult of the two, and we got two choices there. One of them is the actual expenses, and the other one's the local sales tax table, plus certain other taxes. So if you've ever used a Schedule A before and you have the ability to link to a sales tax worksheet, that's the second option. Otherwise, you can just type up the total value of all the sales taxes paid. Speaking of those sales taxes, the actual expenses are the actual state and local sales and or use taxes that are calculated on the personal purchases at the general state sales tax rate. I want to point out as well that if you purchase food, clothing, medical supplies, and vehicles as well, that those actual expenses also get included even if the sales tax rate is lower. Some places don't tax them, but the ones that do, they might have a lower rate. Generally speaking, lower rate is going to exclude it from being included, but on food, clothing, medical supplies, and vehicles, they get included in the actual expenses method. And when I say vehicles, include car, truck, motorhome, RVs, SUVs, vans, off-road vehicles, and that also applies to vehicles they purchased and vehicles where they leased. So if they lease a vehicle, it also applies as well. You total all of those taxes together. You don't modify them unless they receive a refund for their sales tax for the same year in the same year. So if I'm paying state sales tax and I get a refund the year after, I'm going to go through a completely different method. And if I get a refund for prior year taxes in the current year, I don't modify the number. Instead, if you get prior year refunds for state sales and use taxes, they become line 21 income. They become other income, as long as the taxpayer also used the actual method in the year prior. So if I totaled up all my receipts and deducted it, next year I'm filing my return, I'm totaling everything up, and I get a check in the mail for a refund, then I include that as income. If I didn't itemize last year and I get a refund of my sales tax, I don't do anything with it whatsoever. If you need more information, I check out publication 525 under recoveries in order to see more information. Generally, if you deduct something and then you get part of it back, you just include it as other income. So it's just taxed under your ordinary income tax rate. You will need to have your taxpayers keep receipts if the IRS ever attempts to verify this. And I want to point out, bolded right here, do not include tax on trade and business purchases. If it's for business, it goes on the business level, Schedule C, Schedule E, Schedule F. Don't include your business sales tax in your personal. This is deductibility for personal level only. Taxpayers that don't want to use or can't use the actual expenses can use the optional sales tax table. And it calculates based off of the AGI of the taxpayer, the federal AGI, plus a couple of other non-taxable things: tax-exempt interest, veterans benefits, non-taxable combat pay, workers' comp, non-taxable Social Security and railroad retirement, non-taxable pension, annuity, and IRA distributions, assuming they're not rollovers, and public assistance payments like TANF, SNAP, heating bill payments, food stamps, etc. You'll notice that a lot of these, I've talked before about how they're not taxed. That's true. They're still not taxed, but they're included in the optional sales tax table, and it actually helps you. It's one of the rare times where those types of things actually matter, but it actually helps the taxpayer because the higher their income, the more sales tax they get to deduct. Usually, though, if your taxpayer is low enough to qualify for public assistance, they're probably not going to have enough expenses to itemize anyway, so it very rarely comes up. That's placed on the worksheet, and there's a worksheet that's in the Schedule A instructions or inside the commercially available software like the ones that we use. And then there are a series of questions that they ask to arrive at an actual figure that you go look up in a tax table. Obviously, on tax software, it does that automatically. It calculates this, generally speaking, as them living in the same state and locality for the entire year, but there are different ways that you can apportion that income out for ratio changes because they moved or because the tax rates changed. If you have a different state, like the taxpayer lived in one state and then moved to another and they're using the table, you essentially figure them both out for the full year and then multiply them by a ratio of the days. So for an example, state A has a table amount, like I go to the table and I see $400. State B, I go to the table, I see $600. If I lived in state A for 120 days, I take 120 out of 365, multiply it by the number. I do the same for state B, and then I combine those two together, and that's going to give me the amount to take from the top level state figure on that worksheet. Sometimes it might actually mean manually calculating on the computer software and then putting the numbers in yourself instead of just allowing it to go for you. Every computer software is a little bit different. If the locality within the state was different, so same state but you moved to a different locality that has a different tax rate, you can use pretty much the same calculations after you figure the dollar value. You do an apportionment of the time. Sometimes, though, the tax rates themselves change during the year. A lot of states actually change, or a lot of localities actually change their tax rates on like a mid-year cycle. So, partway through the year, you go from 1% to 1.2 or something, in which case you basically average out the tax rate during the same time frame. To give an example here, if you have somebody, they live somewhere 1.25% and doubles to 2.5% after the first 183 days, I'm looking right here, 183 days out of 365, I multiply that by the first tax rate, and then I take the same ratio for the other half of the year for that 2.5%, add them together, and that means when I figure it out, instead of using 2.5% because it's the higher one, I'm going to use 1.84% to represent the actual burden during the year averaged out by the time I spent there. You probably will never really have to do this, by the way. I'm bringing it up because it is important to know, and it is in the instructions for the Schedule A, but you'll probably really never have to do it. Once you total, and this is not the actual expenses method, this is the table, the tax table method. Once you total them, you do have the ability to add extra certain sales tax expenses from the following things: motor vehicles that you purchase or lease. If the tax rate is higher than the general sales tax rate, you cap it. Like, it can never be more than the general sales tax rate for those for a vehicle. If you are paying taxes on aircrafts or boats at the general sales tax rate, you can include that as well. And taxes that are paid on a home, including a mobile or prefabricated home, or to any additions or major renovations that you do, you have the ability to deduct those if the state and local government imposes the sales tax directly on the sale of a home or the cost of those renovations, like their tax assessor charges you for it. If you purchase the supplies for the renovations and you're paying the sales tax because you're going to the Home Depot or the Lowe's and you're buying the stuff, or if you're one of those states where a contractor has to do it for you and there's a contract that says that they're authorized to act in your name, then basically you pay those by proxy. So essentially, if you're using the local sales tax table, the simple version is to say, did you buy a car, lease a car, buy a boat or an airplane, or do any major stuff like buy a home or renovate your home and you got sales tax on it. If so, you can total those together and add it on to the tax table. And there's a little line at the bottom of the worksheet in our software that actually lets you just type in a number and it adds it to and then puts it on the Schedule A. And the taxpayers can choose either one of those, whichever one benefits them more, but only one or the other. Either the local income tax or the sales tax, whether they use the actual expenses or whether they use the tax table method. Once you do have that sales tax table amount, line 5B of Schedule A, don't reduce it by refunds of state sales tax unless it's from the same year within the same year. Okay, otherwise do the same thing I talked about for recoveries, where it's basically line 21 income. And basically, long story short, once you're done with all this, no matter which method you're using, the line 5A or the line 5B, this just gets added to the other taxes you pay, like property taxes, real estate taxes, and just factors into your itemized deductions and helps reduce your taxable income on the federal level. Taxable refunds as well. Some states actually, basically you can have this stuff as income. The taxpayers claim the full value of state and local income taxes paid. When they claim them on their itemized deductions, they don't get to reduce them by the amounts of any of their refunds during the year when they're using the income taxes as a method. However, since they very rarely pay that full amount because they get refunds from the state, there's a discrepancy. I claimed $5,000, I got back $1,500, so really I only paid $3,500. The difference between the two of those might possibly be considered taxable to the individual in the following years. States will issue 1099-G, certain government payments for those taxable refunds. Now that same form is also used for unemployment, trade adjustments, taxable government grants, Department of Agricultural payments, and loan gains from farmer loans. So make sure you pay attention to who it's coming from and you're not accidentally putting income on their return for this taxable refund and it's not that and it's supposed to go somewhere else. Usually the income is considered taxable. However, if you do go into the Schedule A instructions, there's a link in the resources section. There are 11 different exceptions to the rule, and regardless of that, if it is taxable, it's going to go on line 10 of the Form 1040 or line 11 of the 1040 NR. If you ever are going to, if you're ever looking at the return, excuse me, and you see the question that's asking, do you have taxable refunds, credits, or offsets? That's where it's coming from. Some final points to finish this up to get you guys out of here. Most software platforms, and by the way, if you have a pressing need to leave right now, these final points are not officially part of the presentation for credit, so you can feel free to actually go at this moment. This is just some final thoughts I'm adding on to it. It'll take about 2 minutes before we get done. Otherwise, if you guys are sitting here still listening, you can back out now. These final points, though, just to help you out on a preparer level, especially with the season coming up. If you're a federal direct partner and you're using the desktop, go to any page of any state return, hit the F1 key or click the help on the top bar. It's going to open up a help window that describes special ways to use the state return. On the online software, you can also click the help button on the top bar and it'll open a new tab in your browser where you can click the state help tab, find your state, and get the same info. Federal direct partners in general can also go to the state resources section of the partner portal, get a PDF file, and those have the codes that they use for the tax districts. For the ones that are highly specific, you need to find the school district code or the county code. That's where you find them. For anybody that's in the audience that is a non-federal direct partner, like a preparertraining.com user, you'll have to obviously refer to your own software service provider without being a federal direct partner. Some other final points. Ohio is a pain because they can be under multiple jurisdictions. As an anecdote, I have personally filed returns for taxpayers in Ohio that have had 6 separate jurisdictions in the same return. So I had to do 6 extra returns in addition to the federal. Pennsylvania can be a pain since a lot of those local jurisdictions can only be filed by paper. So you have to go to the website for the state tax and download it and fill it out by hand, or in some cases they don't even have them online, so you have to physically drive to the office and pick up the form and fill it out by hand. Sometimes you got to call them. It really just depends. Bank product for taxpayers or tax preparers who are using bank products, as in they're not paying you any money up front and the money's coming out of the refund. The bank products pull money from the first return to fund. So try and always do a state return to have the additional refund source, because anything can happen. A refund could get seized or frozen. Maybe the federal refund gets randomly stopped to do like identity theft verification. But the state funds pull first or go first, and your fees come out of it. Having a state return on there and having a state return on the bank product allows you another opportunity to make sure that you get paid, so you don't have to either get stiffed or take them to a small claims court. State returns are also subject to more strict prepare ID rules. So on every return, make sure to put your name, PTIN number, phone number, date, and address in the preparer section, whether you do it beforehand in the online software through the settings menu, or whether you do that at the bottom of the main info sheet in the full version of the return. Have it on there. I know, for instance, Mississippi will not accept any return that is missing any one of those things. I saw a lot of people who had almost every single one of their state returns rejected, and they didn't even realize it until a month later that the state returns hadn't gone through. Don't be like that. Name, PTIN, phone number, date, address, every return, always, no exceptions. Some of them also, by the way, have an email, so I guess throw email in there as well. States have a Where's My Refund feature as well. In most cases, you can use to track it. Some states take a really long time to fund. Others sometimes can fund faster than the federal return. So in general, your rich, populous states, your coastal states, they work better, while the poor, or in many cases, southern states, take longer. I know Louisiana, for instance, can take months before they fund a return, even if there's nothing wrong with it. State budgets are not as flexible as the federal budget, so state tax collectors can be far more ruthless. I have personally seen people from the state put tax liens on a person's home and car for a $16 balance. So take that as you will. There's also a lot of states that have a welfare system, quote unquote, and I don't mean to be offensive by the usage of that, but that's essentially what it's subbing in for. Credits and various things to help lower income taxpayers. Property tax rebates or circuit breakers, heating credits like in Detroit, state level earned income tax credit, Michigan, New York, a couple other places have it. For those types of returns, you might see clients who don't want to file a federal return, don't even have to, or sometimes they only want to do the state return for that credit. So sometimes you can do it, sometimes not. In most cases, you can simply do the return, complete the federal as though they were going to file, and then just file the state separately. Leave the federal in your system, never send it. Not a big deal. If they're not getting anything back from the federal and they don't have a requirement to file, don't worry about it. But the state level returns can be sent independently. And by the way as well, one other final point before I go to the very last slide, state level corporate returns are usually not able to be e-filed in any case. If you're a federal direct partner and you're using the interview software, Quick Start or Silver Partner, try to use the Prepare Note section. There should be a form automatically loaded on the left to give us information for the state level return that we might be needing, like property index numbers for property taxes in Illinois, the name, the grade, and the cost for dependents in the primary or secondary schools in Illinois, the specific cities, counties, and school districts that they live and work in, and dates that they live there and work there for Ohio, Pennsylvania, whether or not they have food stamps for Georgia, etc. Generally speaking, if you play around, you can find out what is required and let us know and get that information as part of the interview process, so that way we can get it reported when we get the returns in here from our Quick Start or Silver partners. Some resources to help you out: IRS main site, Pub 17, pretty standard resources there. Various State Department revenue websites. You can search them out online. I'm not going to put 50 links in here. As well, I got a lot of this information from the All States edition of the Individual Income Tax by State Guidebook by Tax Materials, Inc. It's called The Tax Book. We actually do have that at a discount for federal direct partners, like heavily discounted. And I'm sitting here holding it in my hand right now. It's like 2 inches thick. It's got a bunch of tabs. You can take pages out and replace them if they update it. It's got all kinds of charts on it and special rules for each state. It's great. And finally, Schedule A and Schedule A instructions. So if you need them, feel free to click them. Those are inside the PDF that you downloaded, and you'll be able to access any of those links. At this point, it's time for questions. If you have any, throw them over there on the right-hand side. If it's specific to a particular return you're working on, I apologize, but I can't actually discuss it on a specific level to a broad audience. Feel free to call into our office Monday to Friday, 8 to 6 Eastern Standard Time. Tax season, our hours are going to increase until we're sitting in here from 9 to 9, Monday to Friday, and 10 to 6 on Saturdays. As well, any questions, comments, concerns, shoot them over to webinar@federaldirecttax.com. Otherwise, I'm going to go ahead and take a look and see if there is anything over here on the side which is relevant to the discussion at hand. And if you have stuck around and you don't wish to listen to the questions, your participation's log ducking out is not going to affect the reporting whatsoever.